Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. Good morning, Tyler. How are you?
Good morning, Dean. I'm doing great. How about yourself?
Good, thank you. Today, we're going to talk about financial goals for 2019. It seems to be each and every year people put goals together, mainly as a New Year's resolution. They'll put things like losing weight or maybe quit eating sweets. And unfortunately, many times those New Year's resolutions go away in February. So what we're going to do is we're going to challenge our listeners to put together some basic financial goals for 2019 that we think are going to help you both as an investor and as a potential retiree. The first one we're going to talk about, because we are in the late stages of 2018, preparing for 2019 right now, and that is volatility in the market. One of the goals we'd like you to have for 2019 is being able to handle and understand some of this market volatility. Now, I'll start off by saying that there's one certainty when it comes to the stock market, and that is everything is uncertain. In other words, I mean, there's absolutely no guarantees, when you're in the stock market. So what you need to do is understand, you need to do the best of your ability to understand volatility, and there are some things that you can do to help offset some volatility. But remember, market volatility is going to bring all portfolios down. It's just that we don't want to go down as far as the market. It's fair to say that most people are watching the news right now and they see the market in December down, 10% alone, and they think that their portfolio is down 10%. Chances are it's not, only from a standpoint of we see most portfolios are balanced to a certain degree. And what happens here is you look at certain portfolios and they carry some cash and they carry some bonds and they carry some NASDAQ, some Dow, some S&P related investments. So therefore, what you're doing is you are trying to spread the opportunity for wealth and spread the opportunity to mitigate downside across a number of different assets. So chances are your portfolio isn't down as far as the market. So go back in and look at your portfolio. Don't just look at what the market is doing and say, well, that's exactly what my portfolio is looking like. So there are a couple things that you need to look at. And remember, first of all, you need to pull the emotion out of it, which is going to be very hard to do. This is a personal decision, of course, to create investments. And I'm now asking you to pull the personal feel away from your decisions. We had this last week. Some people question whether they should move all to cash. Now, I understand they're not sleeping at night. They don't feel well. They're watching the market. They're not watching anything else. And remember, when it comes to the media, you're going to see both sides. You're going to see people that say we're in a bear market. You're going to hear from people that say we're in a bull market yet. So what you need to do is get through the clutter, look at the basic fundamentals, meet with your advisor, and find out what you should be doing. Part of the reasoning here is if your portfolio felt good in September, it's probably still a good portfolio in December. I mean, let's face it, in that short period of time, your portfolio didn't go from a wonderful portfolio with gains to a horrible portfolio. It's the market. So again, it's very hard. As a matter of fact, you really can't diversify out of market volatility 100%. You can soften the blow a little bit. What you want to do is not get into a situation where you're chasing either. Some people will ask, what investment should we be in right now? I see some consumer staples doing really well. You're right. You should have been diversified before we went into this volatility. And now if you're into a situation where you were heavy with, for instance, tech, and you now want to diversify out of that and go into some consumer staples, a little bit more of a flight to safety, chances are you missed a lot of the protection it was giving, okay? So the best thing you can do at this point is probably dig your heels in and wait until we find out what the market is really going to do. It's bouncing around like a ping pong ball, so we really don't know if we've hit the bottom yet and are starting to even out. If that happens, it's going to be easier to go in and make decisions. But at this point, take away some of the personal element here. Tyler, what else am I missing when it comes to handling the stock market volatility?
Yeah, really good points there, Dean. But when it comes to our first financial goal for 2019, handling stock market volatility, obviously it's very relevant based on where we're at right now because the market has been extremely volatile as of late, basically all throughout 2018 and then heading into 2019. But if we go back to 2017, the stock market was up almost as much as it could, or it was as steady as it could be through 2017, and then fast forward to now, it's kind of all over the place. And that goes from everything from the U.S.-China trade dispute to interest rates rising when many other people think they shouldn't, to companies' earnings reports, to most recently the government shutdown that's been causing the stock market to be very volatile. So like you mentioned, Dean, don't panic based on the media news, and some things that you can do to make sure that you can handle stock market volatility better is make sure that you're properly diversified and allocated. So again, Dean, you alluded to this, but in the first place, you want to have investments that can soften the blow if we do have a big market downturn, but you don't want to have all your investments into things that are super conservative, because if we have a market like 2017, then you're not going to get the full upside. So make sure that you're diversified and allocated properly in the first place, so that way if we do have a big market downturn, you're not caught being down more than you think you should be. The other thing is to rebalance periodically. And what I mean by that is in 2017, if you had a portfolio that was 60% stock funds and 40% bond funds, by the end of 2017, you could be somewhere at 80-20, 80% stock funds and 20% bond funds, because stocks did so well, they kind of knocked your allocation out of whack. So you want to go back and rebalance and get back to that 60% stock, 40% bond allocation that suits your investment risk tolerance a little bit more over time. Because if you don't go back and rebalance, and you're going to have a much more aggressive portfolio than you think you do, especially when we have a market downturn. So the main things that you can do to handle stock market volatility for 2019, make sure first off that you're properly diversified and allocated. Rebalance periodically, whether it's quarterly, semi-annually, or annually. And then also just confirm that you're holding investments that suit your needs based on your time horizon, your risk tolerance, and your age. So make sure that you're properly allocated before we have any volatility, and that should minimize some of the blow.
Okay, and a couple other things here too, Tyler, when we're talking about volatility, and we'll spend a little bit more time on this just because we hear so much right now, whether it's in the news or in our office or any other advisor's office, I'm sure, is the volatility and whether the investors can do something differently. But remember, when it comes to this volatility, we're seeing significant swings, both positive and negative, here towards the end of 2018. And that's usually indicative of waning consumer confidence and also geopolitical issues. And as Tyler addressed, some of the geopolitical issues will fall in place. We will get something done with China. Don't know what it's going to be, but you've got the two largest economies in the world going toe-to-toe in a potential trade war. And I think consumers didn't think it was going to last this long and are looking for some sort of closure. And I do know our administration is working on that right now. So, I mean, we will see that part of it pass. The other thing, too, is again, we are working with a government that has no budget right now that has been agreed upon by both Democrats and Republicans. Once that comes into play, again, we'll see things settle down a little bit. But the indicators are showing with these significant swings that what we're going through right now with the volatility leans a little bit more towards the fact that we're getting a good old-fashioned correction versus an extended bear market. So, I mean, again, no certainty there, but indications show. And if that's the case, if we come out of this with some decent earnings in the first quarter of 2019, we get some of the China-U.S. trade negotiations done. I think you'll see things fall in place a little bit more because economically we're looking very strong. I mean, we don't see inflation on the horizon just yet. It will. We don't see recession hitting us right now. We see financial institutions that are very sound, unlike 2008. We don't have TARP money paying off companies like General Motors and Lehman Brothers and so on. So, I mean, we're not seeing, subprime mortgages out there that are very prevalent like we saw in 2008. Economically, we're much stronger. This will pass. Just we do understand the pain that most people feel when we're talking about volatility. So please, as Tyler said, There's an opportunity to still take some of your gains off the table from 2017, build up some cash so you give yourself an opportunity to buy some investments at a low. We are going to have some investments that are on sale. There are some great stocks out there that have been hit relatively hard, and there might be a good buying opportunity. But if you don't take some of the gains that are still left from 2017, move them into cash, it's going to be hard for you to be able to buy these investments at a low.
Yep, good points there, Dean. So we'll move on then to the second financial goal for 2019, and that is creating a plan to pay down debt. So in today's day and age, this is what we see a lot with clients. Everyone comes in, or almost everyone comes in with some form of debt, whether it be credit card debt, school loans, auto loan. Obviously, a mortgage is the main one, but that's something that the mortgage is something that you're going to have to pay off over time. Let's focus on all the smaller debt out there that we can try and get rid of. So make 2019 the year that you get out of all debt. And with that said, by eliminating debt, you can then free up money that can go elsewhere. Like you can use the money that you were using to pay off your auto loan or your student loans or your credit card to then build up your savings, your emergency funds, your retirement accounts, or maybe even go shopping with it. Whatever it might be, you can take that money and allocate that elsewhere, and it's really going to free up your budget and your expenses and different things like that. Now, when it comes to paying down debt, you always want to have a plan. And there's usually two different methods or two ways to go. Both of them work, just two separate strategies. The first method when it comes to paying down debt is we like to have people list out all their debts, starting with the smallest balance and working their way on down the list to the largest balance. So write them down. Forget about the interest rate. Simply do the smallest balance and then down to the largest. And what you want to do is you want to pay as much as you can toward the smallest balance, and then at the same time continue to make the minimum payments on the larger debts and work your way on down the list, knocking each one out one by one, starting with the smallest balance and then going down to the larger balances. And this method is called the debt snowball effect, and it's used more so to give momentum where you see the debt balances disappear quicker early on. So by doing this method, smaller ones, you can knock them out faster, and it kind of gives you more momentum when you see each one of them being knocked out one by one. You can pay off your debts quicker, gives you more momentum to continue to want to knock out the larger ones as you go on down the list. So again, first method, smallest debts all the way down to the largest ones, pay them off one by one. This helps you sustain momentum, and it kind of gives you that feel mentally where, okay, I see one of them gone, I can continue to do this. Now, the other method is to list out all debts starting with the highest interest rate debt first. So forget about any of the balances. Simply list out the highest interest rate and work your way on down the list to the lowest interest rate debt. Now, when it comes to this method, paying off debts with higher interest rates first can save you more money over time, because obviously the ones that have higher interest rates, if you don't pay those down sooner, it's going to be charging higher interest over time. But if you can pay those off sooner, then you're going to be saving more money. But what we find is with this method, you have to be very disciplined, especially if some of your higher interest rate debt has larger balances, because then it could take a while. So for example, if you have a large credit card loan out there that's a very high interest rate, that's the one that you'd pay off first. But again, it might take you a long time, maybe anywhere from 2, 3, 4, 5 years to pay down that one debt. And what happens is if you're not too disciplined, some people might say, you know what, this is really getting hard. Forget it. I'm going to either not pay it or go back to making the minimum payments, and it's going to take a heck of a lot longer. So with this method, you have to be very disciplined, because you're not going to see those small debts go down one by one. You might have higher interest rate debts that are a larger balance, and it's going to take some time. But either way, whatever method you choose, try and choose one, get all your small debts knocked out, and then work on the mortgage and try and make 2019 the year that you get out of your debt.
Okay, good. A couple other points here to throw on top of what Tyler was talking about. First of all, don't look at a zero-interest credit card as an opportunity to pay off debt. We see more and more people bring up in our conversations that they have a zero-interest credit card, so they're going to borrow on that for a while until all of a sudden the day comes where they have to start paying interest, and then they're not prepared for it. So what do? They get another credit card to borrow against. I mean, that is never going to end, okay? It's a snowball that goes downhill, and once it gets momentum, you're not going to stop it. The other thing, too, with paying down debt, look at your 50s. Okay, 50s are a critical time for most people because you now start to see light at the end of the tunnel called retirement. Okay, so retirement is getting closer. In your 50s, you want to be as aggressive as you possibly can to pay off your debt. However, do not use your retirement accounts to pay off your debt. Same thing. We'll talk to people. They'll get close to retirement. They say, okay, I've got $60,000 left on my mortgage. I'd like to take money from my 401k or my IRAs and pay that off before I retire. Why? If you have the ability and you're working, feel the pain a little bit, allocate more of your paycheck towards paying off debt while you're still putting money away for your retirement. Because if you use those retirement funds to pay off a lump sum of debt before retirement, when you have the ability to use your payroll to pay it off, you're never going to replenish that money dollar for dollar. It's just not going to happen. And the other thing, too, in your 50s, it doesn't really have to do with paying off debt, but look at Roth conversions in your 50s, too. Gives you a great opportunity to still have 10, 15 years of opportunity to get some growth in those Roth accounts. Okay, the next thing that we want to talk about as far as 2019 financial goals is saving 15% of your gross household income. Now, this is a big one, and this is one that we want to really spend a little bit of time on explaining it. But before we do, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, we're back, and we're going to talk about saving 15% of your gross household income. Now, remember, that doesn't mean 15% has to go all into your 401ks or your IRAs. It can be used for some cash positions. We'd like to see people build up an emergency fund, use it for cash positions. It can be towards some property, so on and so forth. But 15% should be a goal. Tyler, what else do we have to say about the 15% rule?
Yeah, Dean, the other financial goal for 2019, like you said, save 15% of your gross household income. Now, I've had a lot of people ask me this, especially young people. They said, okay, I'm doing the hard work of putting all my money away for retirement, but what's the end goal? What's that end number that I want? And I tell people there's really it all depends on your expenses and various things at that time once you get to retirement. But a good rule of thumb is to save 15% of your gross household income while you're working into different various retirement accounts, savings, emergency funds, whatever it might be. But 15% is the key number there. And the next step becomes then, okay, if I'm going to put money into my retirement accounts, where do I go first with it? And what I tell people is typically when it comes to your retirement accounts, the first place to save is usually within your employer-sponsored plan. So again, that's your 401k through work, your 403b, 457 plan, profit sharing plan, retirement savings plan, whatever it is that you have through work, that's going to be the first place that you should go if they have a match. Now, if they have a match, again, that's free money, so you want to take advantage of it. There's plenty of employers that they'll match up to 3% or 4%, 5%, 6%, whatever it might be. Especially if they have that match, that's going to be the first place that you're going to want to go because they're giving you free money, so take advantage of it. To go along with that, for 2019, people can contribute up to $19,000 if they're under 50 years old, or $25,000 if they're 50 or older for 2019. So there's a catch-up contribution of an extra $6,000 if you're over 50. So take advantage of those because in your employer-sponsored plan, that's a good amount to save. So saving 15%, you can definitely work your way up to that. But again, 401k, 403b, different accounts like that through work, you can contribute a good amount. So again, if they offer the match, definitely go there first. Then after that, go outside to a Roth IRA. And we really like Roth IRAs due to the tax-free benefits that the Roth accounts offer. And if your employer doesn't offer a match, then it might be a good idea to go straight to the Roth account. But keep in mind, with the Roth account, there are a few guidelines that we have to follow, with a couple of those being, first off, you have to wait until 59 and a half to withdraw money without tax or penalty. Now, anything that you put in, you can take out at any time, but the gain portion, you have to be 59 and a half to withdraw without taxes or penalty. The other thing with a Roth account is that there is an income limit. So for 2019, if you're a single tax filer and you make over $122,000, or if you're married filing jointly and you make over $193,000, then your opportunity to contribute to a Roth account starts to phase out, and eventually you're not going to be able to contribute. So if you make over a certain amount of income, you can't contribute to a Roth account. And in addition to that, there are also contribution limits for a Roth IRA. So in 2019, you can contribute $6,000 if you're under 50 years old. $6,000 and no more is what you can put in. Now, if you're 50 or older, that number jumps to $7,000 is what you can put in 2019, and no more than that. So again, there are contribution limits with a Roth account, but we do really like Roth accounts. The next place to save after the Roth account is you can either go back to your employer-sponsored plan through work to get up to that 15% of income into your savings, or something that we also really like would be starting what's called a non-qualified or a non-retirement account due to its flexibility. And what I mean by that is it's money that you have after tax dollars, so you already paid taxes on that money in checking or savings. Then you put that into a non-qualified account. It can be in various mutual funds, ETFs, stocks, bonds, annuities, whatever it might be. You can invest in those, and anything that you put in, you don't pay taxes on. But when you take the money out, you will pay some taxes on the gain portion. So again, it offers good flexibility. The thing with a non-qualified account is that you don't have to wait until 59 and a half years old to take money out. So you can put money in at any time and you can take money out at any time. We don't have those guidelines. And there's also no income limits or contribution limits. So you can put in as much or as little as you want as well. So when it comes to saving 15% of your gross household income into retirement accounts, there's a number of accounts to choose from, whether it be your employer-sponsored plan, Roth accounts, non-qualified accounts, traditional IRAs. There's plenty of different accounts out there. So again, try and work your way up to 15% of your household income into retirement accounts year over year, and you should be set.
Okay, the next financial goal we want to talk about for 2019 is create a budget. Sounds like a boring topic, but it's very, very effective. We find that those people who have a budget, regardless of how much money or how little money they have, typically feel more comfortable in retirement. Part of the reason is they've got some guidelines. And when you have a budget in writing, designated to writing, you put more time into it, chances are you're going to stick with it. When we sit down, we put a financial plan together for all of our clients. Anybody who wants a financial plan can come through our door, ask for it. It's complimentary. We'll sit down and give them some guidelines here. And this plan should be good for 20 or 30 years of your retirement. But the thing that it does do the best, again, is it either reaffirms where you're at or completely opens new doors that you didn't think were out there and you need to address. So designating things to writing in a budget is a good thing to do. Tyler, what else about the budget?
Yeah, Dean, another financial goal for 2019 is simply creating a budget. So if you feel that either your spending might be out of control, or if you're simply trying to eliminate debt like we talked about earlier, or work your way up to that 15% of your income into retirement accounts, then a budget can help you accomplish those goals. And again, like you said, Dean, we have budget worksheets for our clients that really come in handy when it comes to creating a financial plan. And I find that plenty of different people can use a budget, whether it's younger people who are just getting started on their own and they need to try and budget to make sure that they can pay down their expenses, pay off their debt, save enough for retirement. A budget will help them do that. But then in addition to that, a budget can also help those who are heading into retirement and they need to determine their expenses so they make sure they have enough income to cover those expenses. So whether you're younger or you're older, creating a budget, it can help no matter where you're at. But one thing I tell people is whenever it comes to a budget and whenever it comes to your expenses and income, the bottom line is to always make sure that your income is greater than your expenses and you're going to be just fine. But in order to do that, in order to find that out, that all comes with sitting down, creating a budget. There's plenty of online programs that have pretty much every expense a person has, and all you have to do is go through each line item one by one and simply plug in what you think your monthly expenses are. When you're first starting out with a budget, you're going to have to do a bit of guessing and checking because, again, when you're first starting out, you might have some variable expenses, but the main step is creating it, do a couple months of guessing and checking, and then after a few months, you're going to kind of get it down where you know, okay, this is, $3,000, $4,000, $5,000, $6,000, $8,000, $2,000. That's what I spend each and every month. But creating a budget, that's a good financial goal. That will help you eliminate debt over time and make sure that you're saving enough in retirement over time as well.
Okay, the other thing it does too with a budget is it also gives you an opportunity to say, okay, if you had a standard rate of return on your investments, how long would your money last? So, I mean, that's very important. And also for those people who are looking at Social Security, I mean, that's a daunting thing to go through, is choosing the time and date for you to take Social Security, because many times when you do choose an option for filing Social Security, you can't reverse it. Or it's very hard to reverse it. So in situations like that, by putting a budget, you can model out based on your expenses, based on your income, based on other monies you currently have going into retirement. Is it better for you to take it at 62, 64, your full retirement age, 70? So those things are modeled out, so you'll have a little bit more comfort knowing that your Social Security has been modeled. And the last thing we're going to look at here when we're talking about 2019 financial goals, just briefly, and that is don't miss deadlines. There are some very basic deadlines out there that you don't want to miss, especially if you're going into retirement. In that 65, you need 3 months prior to your 65th birthday or the month of or 3 months after, you need to make sure you file for Medicare Part A unless you have an HSA going on. 59 and a half is what the IRS considers your retirement age, so don't miss that. You can start withdrawing from your retirement accounts without a 10% penalty. Next one is 70 and a half. The year you turn 70 and a half, you need to look at required minimum distributions from qualified accounts. And then the big one that everybody needs to be aware of is April of every year, and it's a moving target because the date changes a little bit. April is tax time, so we don't want to miss those. Tyler, anything else that we need to talk about as far as the 2019 budget?
Not too much, Dean. Just that make sure if you're going to be 65, if 2019 is the year that you turn 70 and a half or 59 and a half, again, be aware of these deadlines because of stuff that you don't want to miss in terms of Medicare, your required minimum distributions, and penalty-free withdrawals from retirement accounts. So again, those are some of the financial goals for 2019. I know we're coming to the end here, 2018. Make sure you get everything wrapped up for 2018, and we'll make it a good 2019 when it comes to your financials.
I agree. That's all the time we have this week. See you later, and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.